Welcome to the daily update, where I'll go over the action in the market for Tuesday, July 1st, and we'll see how things look for Wednesday, July 2nd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Had a good day for the broad market, but not a very good day for the mega caps and growth. It took a pretty big hit, and that's why we ended up having a down day for the S&P 500. Not down very much, but it was the first trading day of the month and of the quarter, and we saw some repositioning going on into the other areas of the market, which could end up being positive instead of just a few stocks really having the most impact on the S&P itself. We saw those stocks kind of get pushed in the background where other stocks saw more favor. So right at the open, we had a lower open, and there's this buy the dip that's still continuing with the market. Prices were able to climb back above the daily pivot at 61.98, but we hit resistance at the unchanged level. So we're dealing with the 6,200 level now. And then we declined back down to S1 at 61.82. Then prices climbed back above the daily pivot and the unchanged level. It looks like, okay, maybe we're going to see a little bit of a shift going on. But there was a real lack of late day conviction. We didn't really see any selling going into the close. We didn't see really any buying. We just chopped sideways. We closed below 6,200 and at the daily pivot. So we were down 0.11%, not a real big move on a percentage basis, but we were above average with volume. First trading day, you have money coming into the market. You have the new quarter with hedge funds and money managers and people trying to get in right off the bat. So that was a little bit different day than typical. It's more of a money management type of a thing. And we're still positive on all time frames. And now we're generating a golden cross with the S&P 500. We generated that a day or two ago with the SPY, the ETF for the S&P 500. Now we're seeing that with the index. So we're seeing that with the NASDAQ 100, the S&P 500. So things are actually switching back and looking more positive, but we're possibly coming into a few days anyway of weak seasonality. All right, so some comments. The Senate passed its version. This has been kind of convoluted here, of the one big beautiful bill, and it's an arbitrary date. There was just this idea by President Trump, I'd like to be able to sign this on the 4th of July. It could go till next week. It could go for a little while there, but they put these deadlines on there to have it be more ceremonial. And actually, Vice President Vance had to come in and cast the vote. There's a lot of controversy about this bill. There's people that are actually voting for the bill that really disagree with some parts of it because it's so big. And it's like there's all these projections and forecasts. And, well, are those things actually going to happen? Or on the other hand, it's like, well, we've got to get the tax cuts through, or that's just going to decimate the economy and decimate most people. So that has to happen. And yeah, we have to increase spending, but we're going to use that money to decrease spending in the long run. And it's like, okay, when has the government ever done that and actually been successful? All right, so now it's going back to the House. That's where it started. It started in the House. They came up with their version. Then they sent it over to the Senate. It was debated and changed and modified. They passed their version of it. Now they have to go back to the House again for more debate. And the idea is that on Wednesday during the day that they're going to vote on it. So that could be kind of some big news that's happening in Wednesday's trading session. And then Fed Chair Powell came out and said that the Fed would likely have already cut rates if it was not for the size of the tariffs. Okay, well, we haven't really seen much of an impact. Now, that this can bleed through and take some time, and there's some debate back and forth. Well, the tariffs aren't going to have that much of an impact. Other people say, yes, they are. But this was just the idea that Fed Chair Powell said, well, yeah, we would have already come in and cut rates if it wasn't for the tariffs. And it's not like Powell and Trump are buddies these days. Trump has already many times voiced his displeasure with Fed Chair Powell. But again, Trump is not a politician. He's a businessman. And so he wants to do things that's going to stimulate business, where Fed Chair Powell is an economist, and he's trying to do things that, even though the Fed's been late historically, not just because of Powell, but going way back. You can go back to Greenspan and Bernanke and, the Yellen and all these other folks that have been the chairperson of the Fed. And it's like, okay, all these things happen, and then the Fed reacts. Instead of being proactive, they're more reactive. Then there was also a report that the president he's not thinking about extending the tariffs that were paused up until July 9th. That's part of the bounce up that we saw from the April lows. Was, okay, we're going to still have tariffs, but we're going to delay them to July 9th. Well, July 9th is going to be next week. And so if those tariffs don't get extended, what's that going to do? And then there's also rumblings from the president that the U.S. isn't likely to make a deal with Japan. Okay, it's a huge trading partner with the U.S. Are we going to be able to sit down and actually make some kind of a deal that way? And then mega caps and growth underperformed. Growth just got hit. It was down about 1%, where value was up about 1%. And as I talked about, we're seeing some of this repositioning. So the equal weight, the SPEW, SPEW, that outperformed. That was up more than 1%, where the S&P index itself ended up being down. Then we are seeing a golden cross. I'll show that. I use the 50 period, 200 period moving average, and we'll see where that's starting to cross above. And that's called a golden cross. Where it crosses below, that's called a death cross. And then here's our list, still showing pretty good momentum in the short term, but we're starting to look a little extended with things that we don't see on this list very often in the short term. We now have the 20 period exponential moving average looking extreme, and the 20 period moving average study, which with that really went up, and I'll show the chart here later. To see that go up, but the mega caps and growth underperformed, that's actually could be end up being more positive, because we're seeing more broad participation. But then we have our usual charts, the StochRSI, Williams percent R, CCI 14 and 20. They pulled back a little bit, but they're showing good positive momentum. But at the same time, you can also say, well, they're getting a little overextended, but they can stay overextended longer when we're in a more positive environment. And the slope oscillator and all of our oscillators are showing some improvement. They've had a chance to try to connect to more of what's going on as they're improving. We're still far away from the 20 period moving average, and the short-term RSI is still extreme. And then intermediate term, kind of a long list here. We're not only far away or looking extreme with the 20 period moving average, we're also looking extreme with the 50 period exponential moving average. The standard deviations chart, we're still in the +3 channel. The CMB composite, the rate of change going back 50 periods. Our momentum oscillator, some of the short and intermediate terms, even though they're turning back positive, they're extreme positive, where the long-term momentum oscillators are improving and they're starting to turn up, but they're still negative. The Sean trend meter, we're still far away from the 50 period moving average. The bullish percent index, both for the S&P and the NASDAQ 100. And the ultimate oscillator, that's a new addition to the list, and we're still looking rather extreme with the RSI intermediate term based on 14 periods. No change to the scenario. It's like, okay, we're just going to have to wait and see. We would have already cut rates if it hadn't been for all these tariffs. Okay, we would have won the game if the other team hadn't scored more points. So, yeah, all right. And then the dollar continues to decline. We're getting into the 96 range. And now that's good for stocks. It's bad if you want to do some traveling, but it does help internally, domestically with the U.S. with the exchange rate. And we did tick up to 4.25% with the 10-year yield. And we did come down a couple of notches. We're still looking positive as far as sentiment. We came down to 65 where we had been at 67. And I'm still keeping the bias, even though we had a down day, to see the rest of the S&P do a little bit better. That's why I kept us at positive. where the momentum is still positive for right now. Okay, so economic reports had some a longer list than what we've seen, at least in Monday's session here. This is a big one. ISM manufacturing, it was actually up. Last time we had the report, it was at 48.5. It's below 50 is showing contraction, but now it bumped up itself to 49. So, and that was greater than what they had expected. So it's still showing contraction, but less contraction when it comes to manufacturing. And we're going to get the services report later in the week. Then total construction spending was down 0.3% month over month, more than the 0.2% that they had expected. Last time it was down 2%. And then they break it out into total private construction was down 0.5%. Public construction was up 0.1%. And then year over year, construction spending is down 3.5%. And the JOLTS job openings, this was one of the surprising things. Now, we're going to get a wave of employment data, including the big employment report on Thursday, so we're going to be getting lots of different numbers. In Wednesday's session, we'll get the ADP employment change. Well, the JOLTS job openings, where it had been coming down, now it actually went back up to 7.769 million. Last time it was at 7.395 million. And then the global U.S. manufacturing, you would think this would be pretty big, but it's really not that big of a deal with the market. But it's above 50. It came in at 52.9, up from the 52 that we saw last time. All right, so here's the chart of my goodness, I'm having a hard time. Construction spending, where it's declining. And that's not good from an economic standpoint. We want to be building things. And to see this going down on an annualized rate is showing some economic weakness. Then year over year, we look at this, we break it out with residential. That's the blue line. That's going down. Where we're seeing non-residential, which is more public, like parks and libraries and things, that's actually going up. And then month over month, we saw a drop off where you can see for the last number of months, we have been negative going back to last fall. And then the ISM manufacturing, the blue line, that went up, but it's still below 50. This dashed line here is the line between expansion and contraction, where we saw orders dropping off, which is showing some economic weakness there. And then when we look at the prices, it really shot up and it's continuing to go up, but deliveries are actually going down. This could be more inflationary. And then exports and imports, the blue line are the exports, and that's going up, and the imports are actually going up too. So it's like, okay, we have all these tariffs, but we're seeing these lines actually going up instead of down. And then the index itself, just a little bit below 50 right now. The job openings, we've been seeing a gradual increase here. We go back to March, and we saw more in April. Now we're seeing more in May. So that's showing economic strength, and that's suggesting from this chart that the employment situation is still holding up. But we'll get more numbers as the week unfolds. This is another look at that same thing. There's a lot of lines on here, but this also compares it with what we've been seeing with the jobs report that comes out, where we had been declining over the last couple of years, and now it's starting to go back up. And then we have the total non-farm down here at the bottom. And then we have people that quit their job. That's the green line. That's been going up just a little bit. The hiring has been coming down just a little bit as well. And the layoffs are still fairly low and actually declining, according to this survey. Then we get this once a week. This is the overbought, oversold composite. Getting a little toppy. We're getting above that 80% level. And when we get above that, now we could still go higher than this. But this is when we say, okay, maybe the market is starting to overdo it. And we're seeing some of that with our short and intermediate term indicators. But in the meantime, this can still go up and show that there's solid momentum to the upside as well. And then the earnings per share growth for select U.S. equity indices. This is the S&P. This is the one we look at. We're looking here at 2024. And then here's 2025, where we're seeing things coming down, but they still project it looking better going out into 2026, and also improving with the equal weight. The NASDAQ 100, that's growth. That's actually coming down looking out into the future compared to 2024. And then mid caps, and this is usually more optimistic for the mid caps and the small caps. They're all going to be large cap stocks by 2026. But then as we get closer, we see really big revisions down to these actual numbers. Okay, asset allocation above zero and going up, where most of the commodity trading advisors are recommending to be longer in stocks now. And then negative revisions to the 2025 earnings per share, consistent with the historical pattern. And that every time we see this chart, I bring this up that an analyst will have really rosy projections down the road, but then as we get closer and closer and closer, it's very common to revise those earnings down as you're getting closer to that date of actually being reported. And so it's very common to see this continue to go down. Then PEs, we seem to be getting a lot of these lately. When we look at the NASDAQ 100, 20 and above is considered to be expensive. Well, we're at 28. And then again, this contradicts the chart that I show over the weekend. I have the S&P 600 small caps at around 15 or so, where here they're showing the Russell 2000 small caps at 24. That means that the small caps, according to this, are overvalued. And then the S&P 500 at 22, which is also above 20. The equal weight, a little more down to earth. It's a little bit above that 15 level, coming in at 17. And then the mid caps are a little bit lower than that. Where typically the chart that I show shows the mid caps a little bit better, and then the small caps even under that. Okay, then looking at the financial conditions index, we've been seeing weaker than expected economic reports. And so we're seeing a lessening of the financial conditions. And then we're also seeing a decline here with as the conditions are loosening a little bit, which could end up being more positive for the market. Then looking at the market cap, you can see the US has a gargantuan market cap when compared to the rest of the world, like Asia and Europe. And then the individual investors. Now, in Friday's video, which will be for Monday in the upcoming one, that's when I show the latest survey from individual investors. This breaks it down a little bit more and just shows that they've increased their allocations in stocks in June, and it's up to 67.5% from 64.3. That's a pretty big increase here overall. And then the split between stocks and bonds down here on the bottom, and then stocks are on the top, and then we have bonds and cash on the bottom. Okay, and then the takeaway from this, and I don't know if I agree or disagree with this, and that doesn't really matter, but this is what the data is coming up with. It's calling it the dash to trash. The second quarter snapback coming up out of the April lows was led by the perceived lower quality baskets. That means areas of the market that are considered to be have less value, and they call that trash, the dash to trash, because it's clever and it rhymes. This pointed to retail buyers. That means you and me, people that buy our stocks through a broker. They continue to buy the dips aggressively, and the pain trade of positioning flipping to performance chasing. And that's what we're talking about. That's FOMO, when we start to see things going up and people are like, oh my gosh, I got to get in and I'm going to get left behind in all of this. Well, there's a whole lot of data here to try to support this. I wanted to just bring up mainly the conclusion that they're trying to reach here. And then foreign investors against U.S. equities. It says diversifying new flow allocation, not divesting. We're seeing a real decline here where it had been going up. Now it's starting to come down. And then the rally starting point. So what was the value of the market at the time we started going up? And it compares it to other times. When we hit lows back in 2002, we actually hit the low in 2003. But we were well over 20 with the Shiller PE ratio, which I go over in the intermarket analysis video on the weekend. This shows that we were above 20 then. Then when we were coming up out of the financial crisis in 2009, we were really low here. We were about 12, 13 or so. Then after the COVID crash, we were just under 25. Liberation Day low, we were already expensive at that point. And then this is showing what we are now. But again, yes, the market is overvalued and has been overvalued for years now. But when you have earnings that justify that, the market doesn't really care if it's overvalued, and it can stay overvalued. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, so here is the chart. Pretty choppy day. We did have a lower open. We made it back above the daily pivot. Didn't quite get back up to the unchanged level before falling back down to S1. That set the low, and then we kind of just really chopped our way back up. We got back above the daily pivot. We finally went positive there for a while, but then later in the day, we're not really seeing any conviction. We just kind of drifted down, showed some weakness, a little bit of buy on the dip, and we ended up closing right down at the daily pivot. And not seeing much of a change in the initial overnight session, and we were drifting lower as things were developing for Tuesday's session, and just shows the choppiness that we saw during the day. Now we are seeing a bit of a switch here where the red line is above the green, the blue line. I do know my colors. So we've been seeing the blue line consistently above the red line, meaning growth above value. We're seeing that switch right now. Is the market becoming more defensive? Well, one day doesn't necessarily make a trend. What we're looking for, what's happening over a period of time here. So is this just because it was the first trading day of the quarter and of the month, and so folks were getting into more value-oriented types of stocks? And we saw a real decline here. Again, we were going sideways as the market was just not trending there in June. Then we started to break out, and this is just shows that the growth stocks were really outperforming. They took a pretty big hit on a relative basis here with the growth to value ratio intraday. So looking at the growth for the large caps, it was down over 1%, where value was up over 1%, and it was down less for the mid caps with growth, and down a lot less. You see, we're a lot of value. Now, we'll be watching this, and I have growth to value charts that we look at. We've been seeing growth outperforming value, and we have ratios that we look at here. Was this just a one-day wonder, or are we starting to see a generalized shift moving over to value, which that means the market's becoming more defensive? So saw a bit of a hit here with the small cap growth to value ratio, mid cap growth to value ratio, and the S&P growth to value ratio. So we're just wondering, is this the start of something, or just something that happened in the picture of this generally being in an uptrend? And then we did take a bit of a hit with the growth to value ratio here. And we saw a real spike up here with the equal weight version of discretionary. We also saw staples going up, which are more defensive. So overall, we saw the discretionary to staples ratio actually improve a little bit. And here is the new trend. Now we came down a little bit with the green line, but we're still declining with the red line. But we're above 20 and going up and above the moving average. So we are in a positive short-term trend. We're just starting to cross above 20 here with the intermediate term. Green line above the red line, so that's a positive intermediate term trend based on the ADX. And we are still above average with volume. We actually picked up a little bit. Again, it could have been because it was the first day of the month and quarter. And then sentiment, we're coming back up, but still below 20 with the VIX, both with the line chart and the bar chart, and still continuing to decline with the VIX of the VIX. And still in a kind of a downtrend here when we look at the momentum of the VIX as measured by the MACD. We declined with this fear gauge. We declined with this other fear gauge. So some confirmation there. Even though the index was down, we saw the rest of the market actually doing better. And pretty much flat with the daily chart of the equity put call ratio. We're still declining, which is positive with the 5-day chart, and we're declining with the 10-day chart. When this is going down, that's seen as more positive. And pretty much flat with the volatility risk premium, but still above the band. Still looking good here. Actually, the advanced decline lines held up. They continue to set new all-time highs based on price and volume. And we're seeing an improvement with the 10-day advancers decliners oscillator. That's continuing to go up. And we're going up with the short and intermediate term advanced decline ratio. And we saw a drop off in the new highs, but they still have been fairly high. So we're going up with the 5-day and the 10-day moving average of the new highs minus new lows, and really not seeing any new lows for the S&P. A little bit of a pullback here with the boom indicator when we look at smart money indicator number 1, but we're still above the advancing moving average. So this is still positive, but in the short term, we're a little bit concerned, especially if this drops down below the moving average. And we're actually negative with the Chaikin money flow, the histogram. Now, we had a pretty good up day on Monday, but this declined. And then we had a bit of a down day, and we're still seeing this declining. So the red line is now starting to come down. A little bit of a divergence there between this chart showing some negativity where we had been seeing more positive things, especially in Monday's session. But the Chaikin oscillators continuing to go up. If we get up to this red line, that's where we're initially watching this more closely to say, okay, maybe we're getting overextended to the upside. The vortex continues to be positive with the green line above the red line. And then I'm just showing the S&P advanced decline line here, setting another new all-time high with the cumulative advanced decline line based on price, and really going up and showing some conviction here based on volume. And seeing some improvement here with the 10-day average of the highs and lows for the S&P. We were coming down after showing some good momentum. Now we're starting to go back up. But this is a longer-term indicator, so it takes longer for this to show some improvement or some weakness. And now this is improving too. We were seeing where the red line, which is the NYSE advanced decline line, it was a little bit further away from the weighted version of the S&P 500. It's actually starting to outperform. We came right back up to the bar chart here, even though they're on different scales. And we're still looking good with the advanced decline line studies. They're all going up above advancing moving averages. And then a broad market measure of the 5-period moving average of the highs minus the lows, that's continuing to go up. That's showing more broad market internal strength. And we're starting to get extreme with those stocks in the S&P above their 20-period moving average. So this went up when the S&P was actually down. So this just means some more of the stocks inside the S&P participated in the upward move, at least in Tuesday's session. And we're going up with the 50-period moving average study, the 100-period moving average study, and we are improving here. This is something that I was pointing out over the weekend. It's like, okay, we're down here in the 50, 56 range, a percent of stocks in the S&P above their 200-day moving average. It's like, okay, that just means a few stocks are really helping the index to go up. Well, now we're seeing that improve after Tuesday's session. And here is the short-term chart. We had a bit of a down day. The dashed line, that's the previous all-time high here. And we were above average with volume. And right here, you can see where the blue line is crossing above the red line. That is a golden cross. That's changing the intermediate to long-term trend back to positive. And we're starting to get extreme with the 20, and we're just barely extreme with the 50-period moving average on the S&P itself, improving with the 200-day moving average study. And coming down, but still extreme with the StochRSI, the Williams percent R, the CCI 14, and the CCI 20. These are our usual charts that are showing positive short-term momentum. And still looking extreme with the short-term, intermediate short-term, and long short-term stochastics. Declining, but still above the midpoint with the force index. Coming back down, not going below these lines here. So the short-term trend condition is still looking positive. And we are coming down a little bit. We're still in the +3 channel, but we're not right on the borderline that we were showing after Monday. Now, intermediate term, we declined a little bit, but we're still positive with the balance of power. Still looking good with the 10, 20, and 30 moving average study here. The lines are continuing to go up. We're still extreme positive with the CMB composite. Still positive with the go, no go with the darker blue bars. Still hitting the blue line here, which is the highest high value. That's positive. Still looking positive with the Landry light and the proper order. And the TTM squeeze continues to improve, lighter shade of blue. Now, if we get up to this black line, that's when we start to look extreme. And we're starting to show a little bit of pickup in speed here with standard deviation. We're crossing back above the moving average. And again, this doesn't measure direction. It measures speed, whether we're going up or down. Still looking extreme with the rate of change going back 50 periods. And still just barely positive and going sideways with the ease of movement. Still positive and not extreme yet with the Arun indicator. And starting to just almost get extreme with the S&P McClellan oscillator. Again, to have the S&P down and have this go up, that's just showing there's more internal strength, at least in Tuesday's session within the S&P. So we're going up with the summation index based on price and volume, also improving with the NYSE McClellan oscillator. So we're advancing based on price and volume for the summation index for the NYSE. Stalling out a little bit here, but still going up based on price and actually starting to come down based on volume with the swell trading oscillator. So we're getting a mixed picture there. Still going up with the PMO above the red line. That's why it's extreme. Going up based on price and going up with even more, excuse me, even more conviction based on volume. Just below the extreme reading for the PMOs that are rising. Again, this is suggesting the rest of the stocks in the S&P saw some improvement. We are improving with the buy signals, and we're going up with the PMOs that are above zero. Still positive with the Elder's Impulse system for the S&P. Still positive with the parabolic SAR. Positive with the slope oscillator, short term, above the moving average, but above the green line. That's why it's extreme. And the MACD continues to be positive. So short and intermediate term oscillators are turning positive. We're finally starting to turn up with the tricks and a little bit of a turn up here with the KST. But we're just right about on the moving average with the tricks. We're still below the moving average with the KST. Positive now with the Copic curve, moving above the red line. We were flat with the Sean trend meter, but we're still in this darker green area here, so that's still positive. We declined, but we're still above 50 with the money flow, and we're starting to get extreme with the ultimate oscillator. We're above the moving average with unbalanced volume. We're no longer extreme with the percent B indicator. We closed just a little bit inside of the upper Bollinger Band. And still extreme, but coming down slightly with the intermediate term RSI. Coming down, but still extreme with the short-term RSI based on 9 periods. And, excuse me with my voice here. Let me pause this for a minute. Okay, we'll see if that does any better now or if it actually makes things worse. But we're still going up with the red line and the blue line and prices above both. So the intermediate term trend is still looking positive here. And we're still above all the moving averages. And now we've been above this for quite a while. So we're seeing the lines for the moving averages starting to go up as well. That's positive. We're still far away from the 20 and 50 period moving averages as measured by the boom indicator. And we're going up. And this is another thing that shows there was more strength inside of the S&P than just the big stocks. We're going up with the bullish percent index for the S&P, and we're starting to get extreme. We're going up with the NYSE bullish percent index and up with the NASDAQ 100 bullish percent index. And still looking okay. We're up 0.4% so far for the week. And we're looking positive from a trending perspective. When we look at different ways to measure the trend, the Heiken Ashi is positive, the Kagi chart is positive, the Renko chart is positive, and the 3-line break is positive. Long term, saw a big move up here with the 150 and 200 period moving average steady. And this should be changed, but they haven't. So we're positive across the board because both the mid caps and small caps are above their 200-day moving averages. Still negative in the short term with commodities. The dollar just continues to get hammered. And we saw communication and tech. They were down. And these are growth areas where a lot of the more defensive areas and more economically sensitive areas did better. With materials that have been getting hit hard lately, they're actually were the strongest area. Healthcare has been just dismal lately. It was up. And staples have been underperforming. They were up. So these are more defensive. And then we saw lots of green here and with a few reds along the way. First, the NASDAQ got above 23, then it dropped below 23, then it dropped below 22. And then we had utilities had a BPI cross. Well, after Tuesday, we had a BPI cross below 50. Now they're going back above 50. Canada, another day, another new all-time high there. This is the crossover that I'm talking about. The 50 period crossed above the 200-day moving, 200-week moving 200-week moving average? Should be a 200-day moving average. Okay. But it's a moving average crossover. We also call that a golden cross. Staples had a bullish crossover. We'll be watching that to see if the market is getting more defensive. And we also crossed above 50 with the BPI as well. And then materials, they had a BPI cross above 80. And you see the big boxes here, they're red. This is why we ended up being down with the S&P. And Amazon was up just a little bit, but Tesla got hammered over 5%. And seeing a bit of an improvement here, but we're still a little bit of a disconnect with the weighted versus equal weighted version of the S&P. But we're really coming down with the overall ratio, where when this is going up, that means the weighted version is outperforming the equal weight version. That really fell back on Tuesday. And we were up on 0.91% with the Dow, above both of the moving averages. Positive with the Elder's Impulse system. A little bit closer here to an all-time high with the diamonds, which is the ETF for the Dow. And more of a pullback, where earlier in the day, it's like we saw the Dow up, the S&P kind of between positive and negative, and the NASDAQ and NASDAQ 100 were just getting creamed. And you look at the growth to value charts, and they were quite out of line with each other. But we'll see. We're not really hitting any necessarily overhead resistance right now. We'll see if we can get this back after generating a recent golden cross. We've gone from positive to neutral with the Elder's Impulse system for the NASDAQ. A pullback here with the NASDAQ 100 after our recent golden cross, and going to neutral after being positive with the Qs. The momentum, though, is still positive for the NASDAQ 100. And this is the line going back to 2009. This is a weekly chart of the NASDAQ 100. Are we going to hit this? Is this some longer-term overhead resistance that the NASDAQ 100 is hitting? Small caps had a pretty good up day. Still didn't close above their 50-day moving average. Excuse me, their 200-day moving average. But we are above the 200-day moving average when we look at the other small cap index, the Russell 2000. So this is showing some promise right now. Can we see more follow through with this? And we're positive with the Elder's Impulse system for the mid caps, also above the 200-day moving average with the mid caps. So this is the small caps. This is the mid caps. So positive here. And the financial sector was up over 0.5%, setting an all-time high there. And we saw the banks just, wow, just really go up, 2.89%. So that's showing some improvement, even though we're still technically in a downtrend here. And we saw a bit of a bounce up with the financial to S&P 500 ratio. That's positive. And we're just about getting ready to see a golden cross with the Wilshire 5000 that's coming off of setting an all-time high. Also, we're generating a golden cross. Okay, here goes the voice again. With the total U.S. stock ETF. And we were down a little bit after setting an all-time high with this ETF here. Down 1.77% with the FANG index. This was really what was driving things up. These are the big stocks. And we are still in an uptrend, though. Here in Apple, they're still kind of going on the wave of AI showing some improvement, or at least the possibility of improvement with Apple. So that was up another 1.29%. Amazon was up 0.5%. Microsoft was down over 1%, but it's had a pretty good run lately. Google was down 0.22%, still above both moving averages. Meta down over 2.5%, but now generating a recent golden cross. Nvidia generating a golden cross here, but fell almost 3%. And Tesla got hit down here. We were just about ready to generate a golden cross, and now we're dropping below both moving averages. Netflix down 3.4%, but it's had a really good run too. So there might have been some profit taking involved with this as well. Then I wanted to show the bellwethers, where the semiconductor is kind of going sideways right now, but we saw a nice big move up with the home builders. But they've been weak going back to late 2024. The transports actually bumped up a little bit, and this has been another frustrating area. Retail bounced up. That's been underperforming the S&P, and regional banks. So we not only saw the bank ETF, but the regional bank sector here really showing some improvement. Then, still looking a little stronger when we compare the short-term correlation between U.S. and world stocks. Still kind of drifting kind of higher here with the longer-term correlation. We were up. We're getting more into the 65 range now with oil, and we continue to just go down, down, down with the dollar. We've dropped off here with the inflation reading from Trueflation, dropping back down to 2%. And we were up a little bit. We're back to 4.25% with the 10-year yield, and we dropped a little bit here with the 10-year based on price. Still inverted with the 10-year to 3-month yield curve. That's a potential recessionary warning sign. But the 10 to the 2-year, that's still doing fine. And taking a bit of a hit with our growth to value ratios here with Qs to S&P, still under the moving average here, which is declining with discretionary to S&P. We declined back down to the moving average with large cap growth versus large cap value. So coming back down, dropping a little bit below the moving average with the large caps, a little bit below with the mid caps, and really dropping below with the small caps. Again, we're going to see, is this the start of something or just something that was more isolated? With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook then for Wednesday? We're still in a trend. It's continuing to develop, and the trend is still positive on all time frames. We're going to get every week, we get the MBA Mortgage Applications Index, and then the employment data will be the ADP non-farm employment change. And then anything geopolitical, escalation between Iran, Israel, anything domestically as far as protests. Of course, the big beautiful bill, that's kind of hitting the forefront of the news right now. And then we're going to have a pretty big day on Thursday where we're going to get not only initial jobless claims and continuing claims, we're going to get the whole employment report, and we're also going to get the ISM non-manufacturing index. So a lot of these are coming out on Thursday because the market will be closed on Friday. Here's a look at what was it? We got 37,000 last time. We'll see if we're able to beat that or not. Seasonally, we're more negative with the Dow, and we're neutral to negative with the S&P and NASDAQ. We're coming into a few days. You can see here, this is the second trading day where we do see during a post-election year, typically a little bit of weakness until we get through the 4th of July. And then that's when we start to see more positive seasonality after that. This is that same chart, but just taking all the lines and things away here, where we also see some weakness before we tend to see some strength going into about the middle of July. And then this is looking at post-election years have been very strong lately. Okay, this is a post-election year. Past 10 cycles, going back to 1985, it's performed quite well compared to just going back to 1950. Midterm years tend to not do all that well. Pre-election years have been the strongest, and then where usually the conventional thinking is that election years tend to be strong, but it's usually the pre-election years lately that have been the strongest. All right, then looking at this, weakness is normal. This is from the latter part of June going into the first part of July, where we do see some weakness before we tend to see some strength. And then we are positive for July. Now, this is taking the whole month, but it's the post-election year going back to 1950. Up 12 out of 18 times, down 6 out of 18 times with a return of 2.2%. Another day or so, I'm going to take this chart out and put it over in the weekly chart only. And probably the same thing here, where the first part of July tends to be the best performing time of the whole year, going back to 1950. The second half performs well, but not nearly as good as the first half. All right, then we see a little bit of a dip here from June into July before we tend to see some bounce up from that seasonally. And July tends to be positive no matter how you slice and dice it here. This is also showing the NASDAQ with positive seasonality up until about the middle of July. Now, there's no guarantees. We don't use seasonality to make decisions, but we do use it as kind of a guide. All right, the warning signs. We're still negative with our discretionary to staples ratio and the long-term special K chart. But we're getting a mixed picture here with the smart money indicators. Accumulation distribution starting to drop below the moving average with the boom indicator. We're actually negative with the Chaikin money flow. But the Chaikin oscillator is still going up and still looking positive. And our longer-term growth to value ratio chart is still in an uptrend here. The S&P and NYSE McClellan oscillators and summation indexes are positive, as is the parabolic SAR. The bullish percent indexes, they actually went up nicely across the board here for the different indexes. We're getting a mixed picture. We're still going up, but slowing down based on price. We're actually declining based on volume with the Swellen trading oscillator. We are improving with our oscillators here, as well as the Copic curve, but the long-term oscillators are still negative. Ease of movement is positive. The money flow, the ultimate oscillator, is positive, but now looking extreme. The vortex is positive. The financial sector is positive, and the momentum for the NASDAQ 100 is positive. Here are the pivot points for Wednesday's session. So our conclusion, no immediate changes here. We're positive with the trend now happening in the short and intermediate term. And we're just, I'll wait one more day here. I'm going to have to change this over to a golden cross from a death cross here. And that's longer term positive for the S&P. Thank you. I hope you have a really good day on Wednesday, and I will talk to you in the next video.